I think the important thing for anyone who comes in and this is to think like an owner.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time. Hello, everyone. Welcome to Alt Investing Made Easy. Today, we're here with you with Mr. Rohit Sood of Commodore Group Holdings. He is an experienced manager of a fund, and also he's going to tell us a little bit about the kind of offering that he has, a 506c offering that he has available to investors today.
Thank you,
Yeah,
sir.
welcome, Rohit. We're really glad to have you here.
Thank you, Roland. Glad to be here.
Well, everybody, we're really proud to have Rohit, and you know, this is a podcast, a webcast about alternative assets, and we've talked a lot about commercial real estate. We've also talked a lot about private equity, but we haven't had a representative from the hedge fund world here, and hedge funds typically imply longs and shorts. Rohit will tell us more about his particular strategy that does not involve any short positions, but I think that you could still say that he is operating a long-only hedge fund. There is such a thing, and so Rohit, it's great for you to be here. You have a live investment opportunity. That's one of the purposes of this podcast, is to make people aware about investment opportunities that are being offered using the 506c exemption that allows for advertising. So we really want people to find out more information about this investment opportunity in a fund that we know about Rohit, and he's told us about it, and I think it has a lot of integrity and thought in the strategy. So Rohit, maybe you could start by telling us a little bit about your background and how, you know, from your life, how you arrived at this moment.
Sure. So thank you, Roland. Thank you, Sarah, for this opportunity. So my background, started off as a somewhat non-traditional background for investing because I studied engineering in college, went to graduate school for engineering as well. But then somewhere down the line, my interest started going towards finance, and I started my career at JP Morgan Chase in the credit card consumer credit program, doing loss forecasting and consumer credit risk management. So I was it was still involved a lot of quantitative analysis, trying to forecast loss rates for different tranches of credit cards. And I found that interesting enough that I decided to kind of stay on the business side and went to business school at Columbia with the intention of moving into investment banking. And that's exactly what I did for 7 years after business school. I worked in investment banking started my career at UBS Investment Bank, covering financial institutions. So doing investment banking for banks, especially finance companies, insurance companies, capital raising, mergers and acquisitions advisory, and things like that. I started at UBS Investment Bank, moved on to Bear Stearns, continued doing that. And I was there during the financial crisis, so got a front row seat to what was happening in the financial crisis with all the financial companies struggling and going down, especially the over-levered ones. And then following that, I moved on to Friedman Billings Ramsey, which was a boutique investment bank focused mostly on financial institutions and real estate. I worked there for another couple of years, again focusing on financial institutions, commercial credit. And interestingly, one of the things that I did when I was at all of these three places was I did a lot of capital raising for what has now become popularly known as private credit. So I did a lot of transactions for companies like Ares Management and Apollo in the BDCs, the business development companies, raised a lot of capital for them, did IPOs and follow-on offerings and so on and so forth. So got pretty familiar with the financial space. So one of the things that those 7 or 8 years in investment banking really helped me do was really get comfortable analyzing companies and looking at their financial statements and understanding the accounting, understanding the ins and outs of how what the accounting really told you and what it didn't tell you, right? So that was something that I learned, and I think the it I didn't really understand it as much in the beginning of my career, but as I went along, I started seeing the difference between the companies that would do well and the companies that didn't do well. And then I started kind of reverse engineering it, being an engineer that I was, and trying to figure out what were the factors that really led to certain companies doing well and certain companies not doing well. And that was somewhere around the time when I got introduced to, I read an essay which was written in 1984 by Warren Buffett. It was called The Super Investors of Graham and Doddsville. And for some reason, I don't understand why that essay doesn't get as much play as it should. But in that essay, Buffett basically countered the efficient market hypothesis, the modern portfolio theory, and essentially said that it is possible to do better than average, and it doesn't require a whole lot of quantitative, it doesn't require calculus or advanced mathematical modeling or anything of that sort. It just requires a very rational approach to valuing companies and analyzing companies. And that kind of struck me, especially coming off the financial crisis, kind of watching a lot of the transactions that have been done in the past not ending up being good transactions for either the companies or the shareholders. And that, so, I was thinking a lot about what made some of these companies good and not so good. And that essay kind of stuck out to me. And in that essay, what Buffett did was he analyzed a track record of, about, I don't know, 8 to 10 people that were all trained by Benjamin Graham. And they all went off in different places and did different things. And they all ended up having returns over the long run, not over the short run, but over the long run, much better than the market. So I went, I got very, very influenced by that. And that just kind of led me off, down a rabbit hole of finding anything related to that, anything related to Benjamin Graham or Warren Buffett and Munger, the shareholder letters, and essentially changed my entire approach of how I viewed investing or how I viewed financial analysis.
I think that would be good, Sarah, because that those ideas are well known in the marketplace. Benjamin Graham and Warren Buffett, of course. People maybe know Benjamin Graham less, but Warren Buffett for sure. But having a clearly articulable strategy like that gives people an opportunity to immediately attach to, understand, okay, this is what this guy is talking about, and then your own particular spin on it. So I don't know, Sarah, I mean, what do you think?
Look, I think it's great that you have a specific article. And I was just thinking as you were talking about it, because I've read some of Warren Buffett's stuff, and what you're saying sounds familiar. So I think I might have read about that article in a different book that was analyzing maybe successful CEOs. But in any event, we'll try and find a copy of it. We can put it in the comments below. And actually now, of course, I want to read it myself. Because I do like what you're saying essentially, too, is there's a certain cynicism that comes, I think, in thinking that all you can ever do is make, the market, and that, the quantitative or the quants will always prevail over long-term thinking. And I think for some people prefer the long-term thinking in terms of it's just got something more sustainable about it, perhaps, not to, say something controversial, but just there's something that's very stable. And Warren Buffett has certainly proved that with his whole life tenure, really. So, so Rohit, I just sometimes it's we're going to get into the more details about your specific offering and also anything else you want to tell us about what you're involved in. But I do think it's interesting hearing a little bit from you. So tell us a little bit more about your journey, because it is an interesting jump to go from being in a very stable investment banking career into going into essentially launching your own funds to manage.
Sure. And that wasn't without fits and starts. It wasn't a smooth, it wasn't a smooth journey.
Yeah.
For sure. And initially, the investing kind of started off on the side, where I started investing my personal funds. And the idea was, again, as a corollary to that, as a sequel to that essay, I said, maybe I'm not as smart as some of those guys. who got those really exciting returns. But maybe I'm not that dumb either, so maybe I can get somewhere in the middle of, somewhere still better than what I would normally hope to accomplish, but maybe not as good as those, but respectable returns, and that would be good for me. So I started following that approach, but as with anything, it's not as simple as reading a book or a couple of articles and then just suddenly formulating a strategy. I mean, there's only one way to learn about this stuff is by actually doing it yourself and putting your own money in, having your successes and failures, and then going back and analyzing those successes and failures and seeing why they happen. You may not always have an answer, but at least the process has to be there. And over time, I started seeing my returns started ticking up. As I learned from that initially, and I look back at what I started doing like 13, 14 years ago, and boy, I'm not proud of those investments that I made then. But the investments that I made 6, 7, 8 years ago, I'm very, very proud of them, right? So I think there was a natural learning and there was a transition over time. And part of what also aided my transition was, so, obviously I had a lot of experience reading financial statements, reading annual reports, etc. But one of the things that I decided to do to do this is I wanted to automate something. Given that I was an engineer by training, I said, "Boy, is there a way to automate this stuff?" Because we used to do a lot of this stuff in Excel, doing a lot of financial analysis, etc. But is there a better way of doing this? And then I learned about something that was happening in the last 15 years, which is very interesting and exciting. The SEC, the Securities and Exchange Commission, was transitioning all their reporting to something called XBRL, which is Extensible Business Reporting Language. And they were basically making their financial statements of every company was going to be machine readable in the future. So I said, you know what, I'm going to try to write some software just to kind of tinker with it, just to experiment with it and see what information I can get from those machine readable financial statements. So I started using Python programming language, and I started doing it with a couple of companies, etc. But I started enjoying it so much, and the information that I was getting was so interesting that I formalized that whole thing, and I built a whole software platform, which is basically like a real-time analysis platform. It's called Fintuative. And with Fintuative, what we have is we have a platform, a software platform that as every 10K, 10Q, 13F, or mutual fund filing, any filing that comes out on the SEC, the platform consumes those reports, downloads it onto a system, parses all the data from it, extracts all the data, and analyzes it, puts it in a usable format that I can use to leverage it, to basically say, you know what, it was hard, if you're just reading all the annual reports by yourself, which you have to, you can only read a certain amount. But how do you get to a point where you can say, these are the 50 annual reports that I want to read. These are the 50 that are going to be most interesting, the most, that are going to give me the most bang for my buck, for the time that I spent. So I use Fintuative for that, and so this platform, which is a totally proprietary platform, and it's really sophisticated. I think I would say would go out with and compete with some of the quant fund offerings out there. But it took several years to build. It took several years to build, and it's an ongoing process. I keep building and keep adding features and functionality to it, especially based on whatever I see. But essentially, what I do is, from all the financial information that I get, and I have every hundreds of thousands of filings, every filing since 2008 specifically, since the SEC started requiring the XBRL format. But what I do is, with the entire universe of US companies, with 4,000 publicly traded companies, 4,000 or so, every month I compile statistics on them, and I have my own proprietary scores. And the two things that I focus the most on are quality, business quality, and the second thing is value. And business quality is hard to quantify sometimes, right? Because there's a lot of qualitative factors also that go into determining what the quality of a business is. But there are several quantitative factors that can kind of lead you towards analyzing for more qualitative factors. And some of those things are things like returns on capital, right? So, uh, and that might seem very simple, but it's actually not as simple as it seems, right? Because there's a lot of things that go on in the financial statements intricacies that people will do. So you can't just take whatever the stated number is in the financial statements and just say, oh, that's a return on capital, and this is how you have to analyze the capital allocation strategy of management. You know, how are they, the capital that they're earning in the business, how are they reallocating that capital? Are they reinvesting? You know, every time the capital comes in, the management team has several decisions to make. You know, they can reinvest that money in the business, they can pay down debt, or they can raise more capital to uh, expand the business, or they can buy back the shares or pay dividends. So all of these are capital allocation decisions. And not everyone makes good capital allocation decisions. If everyone made good capital allocation decisions, then all these companies would perform well. But there's a lot of conflicts of interest between management teams, owners, etc. So not everyone makes good capital allocation decisions. What I use Fintuative with our proprietary quality score is we try to figure out what the capital allocation decisions of management teams are and how they rank with versus the rest of the market.
Wow. It's interesting just hearing you say that. I used to work in a private equity fund that had telecommunications assets all over the world, and there was an entire team dedicated to analyzing capital allocation in that fund because it's such an important topic. It's not just that the CEO is like, oh, I feel like paying down debt today. It's hugely intricate, and also the more capital investment required for your industry, such as telecommunications, has a lot of, you're constantly having to upgrade really complex equipment. It becomes such a major part of the business that you dedicate entire teams. So it's nice to hear you kind of talk about that, Rohit, because I do think when you're in an operating company, you might have more exposure to that. But when you're from the investor side, you prefer, like you're saying, more composite information. And if there's a way to have complex information also in a composite form, it sounds like that might be what your proprietary scoring process is about. That's the most useful information.
Yes, and to be truthful, I don't rely entirely on the score. It's not just that the score comes in and I just decide to make an investment decision, but these are things that give me clues and lead me on and say, I cannot read 4,000 annual reports and understand, or even if I read them, I'm not going to be able to process that information or remember that information. So I have to focus my time and energy on on a smaller, not the entire universe, but a smaller subset of high quality companies to determine
Right.
where the value is, right? And one of the things, again, going back to the capital allocation decisions and the returns on capital in companies, it's one of the things that a slide that I show people I talk to and my investors, which I think I find very interesting, and a lot of them find very interesting too, is where I lay out four companies. So interestingly enough, when people are thinking about investing, everyone is trying to find the next Google or the next Facebook or the next Nvidia, right? They're saying who's going to have the maximum growth, and you see the analysts, the equity analysts in Wall Street, they're talking about where the growth is going to be, and they're trying to get all kinds of information to figure out which companies are going to grow faster and which companies have the best technology. But going back on the slide, I show four companies, and none of these are high-tech companies, right? None of these companies had great technology. And the company, some of the companies people have heard of, and one of the companies a lot of people actually haven't heard of, and I don't know if you've heard of that company or not. It's a $50+ billion market cap company. But the four companies in that list are, one is Cintas, which is a uniform rental company which rents out uniforms and surgical gowns, etc., to clinics, restaurants, etc., linen and things like that. Just very, very basic, nothing technologically advanced about the company. Another company is Home Depot. Then another was Walgreens and FedEx, right? All these companies people know of. None of these are high-tech companies. And the interesting thing is that between 2012 and 2022, in that 10-year period, and I'm talking roughly, all of these companies increase their revenue 2 times, right? So
Oh,
they
wow.
all double their revenues in those 10 years.
Wow.
But the results in terms of share price were very different for all four, right? So Cintas grew by 10 times, Home Depot grew 5 times, Walgreens only grew 25%, and FedEx only doubled, right? So where did that difference come from? They all grew their, and this is what, interestingly, what analysts and everyone else focuses on is growth, right? The top line growth. And what my point is over here is it's not about growth. It's not about who has the best technology. It's not about, it's about capital allocation. And what Cintas was doing really well in those 10 years was they were really allocating capital really well. And they were under the radar. They were consolidating. If you know this uniform rental business, it's a very, very fragmented business. A lot of small companies. They were using the capital. They had high returns on capital that they were generating. But the interesting thing was the capital that they were generating, they could put to very good use by buying up, consolidating smaller uniform rental businesses, local uniform rental businesses. And because the stock was undervalued, the rest of the money that was left over, they were using that to buy back their own stock. And best of all, they were not willy-nilly handing out stock options to management, right? Which has the effect of diluting and taking away from shareholders, right? So they were thinking like owners. This is the central concept is if you think like an owner, then you allocate capital well.
Oh, yeah.
Well, that brings us to the point where, we can call you a hedge fund. I guess you could call yourself that, Rohit, but we say specifically that you don't use shorts, and there's a specific reason why you don't use shorts, and you just said it.
Correct. And that's a great point, Roland. It's the whole concept of my investment, and I prefer to call it an investment partnership as opposed to a hedge fund, even though I think the SEC classifies it as a hedge fund and other people call it a hedge fund. But I just like to think of it as an investment partnership where I'm managing the money of my partners and investing it on their behalf. And as I said, the central thesis is you think like an owner. So you think like an owner and you want to be the owner of businesses long term, and these have to be high quality businesses. So shorting philosophically does not go with that ownership investing, because shorting is you're being the anti-owner. You don't want to be the owner of a company, and that's not how we approach stuff. Whereas you want to be the owner of a company and you want to think of it long term. Because in the short run, lots of things can happen. There's a lot of volatility in the market. Stock, prices can go up or down. And we believe that's not instructive of, that doesn't tell us anything about our investments in the short run. It just tells us whether we can buy more or stand away from the market during that time. So we don't use, so going back to your point, Roland, we don't do any shorts. It's a long only investment partnership. We don't do any shorts. We don't use any leverage, and we don't use any kind of derivatives or other kinds of leverage by using derivatives or options or puts or anything of that sort. It's a very, very plain vanilla strategy of saying we're going to find a small number of high quality businesses, think like an owner, and buy into them thinking like an owner.
I think we just came up with our episode title.
Yeah. So that's good, Sarah.
Rohit, I just want to say that I think it's so interesting. You've just explained really well the level of detail that a fund manager of your caliber, the way that you think about things. And I've read some of Warren Buffett's books and whatnot, and he talks a lot about case examples, how he analyzes financial statements, and his kind of approach to all of that. And I think that you've just in 20 minutes explained a lot of details about your approach, which I think will be really interesting for people to hear. So I'm just going to propose out here, Roland, that we do another episode to get more detailed into this, specifically in terms of how you develop an investment strategy, if you wanted to talk about that more. But moving on, do you want to tell us about the specific investment opportunity with you, just what that looks like, what you call it, if people want to contact you about that, how to do so in terms of, what you're looking for in investors, et cetera?
Sure. So the specific investment partnership is called Commodore Group Holdings LP. It's a Delaware limited partnership, and it's structured like it's a very common structure of investment partnerships, which essentially, as I mentioned, it's a long only investment partnership. We invest only in U.S. equities. My expertise, I don't have expertise in the accounting intricacies of international companies, etc. So I stick to U.S. companies, which I have a lot of information on and a lot of background in. So U.S. companies only, long only, no shorts, no derivatives, no leverage. It's a very, very plain vanilla kind of a partnership. Right? What we do is we take concentrated positions. Our belief is when you find high quality companies, so there is a finite universe of high quality companies in the US, right, that are publicly traded. And most of them are not cheap, right? So the high quality companies are not cheap. So you are not going to get good returns. I mean, you will get decent returns if you buy high quality companies and hold them for the long term. But if you want to get better than average returns, you want to buy these high quality companies when they become available at a reasonable price. So, and that universe shrinks even further, right? So there's a very small universe of high quality companies available at reasonable or cheap prices. So because that universe is so small, we have a pretty concentrated fund, right? So we say our goal is to have 6 to 8 positions, but we can have as few as 4 positions at a time, or even fewer than that, right? So we don't have any such constraints. So for example, right now we have very few positions just because of how overvalued the market is right now. In general, doesn't mean that there's not good investment opportunities in certain pockets that have been ignored by people, but in general, the market is kind of somewhat overvalued, so the number of investment opportunities shrinks even further. But so the investment opportunity, it's a concentrated fund, and it's an open-ended fund, so that means people can contribute capital at any point of time. The minimum investment amount is $250,000. Although I have a very, very, just like the investments, I have a very concentrated limited partner pool as well. And the average investment from my limited partners is over $1 million. Well, mostly my friends and family.
And maybe just tell us a little bit about your track record, Rohit.
So the track record is very, in this partnership is short. We started this partnership in July 2023, and since then grows. It's just about meeting the S&P 500 this year. As of April, the partnership was up, I think 1 or 2%, versus the S&P down being 5%. But again, so I think that detracts from the goal of the partnership is to say we're focused on. I always have told my LPs is we're going to focus on 5-year compounded returns. This is where we get an advantage in the short run. If you're chasing, and then you become just like all those other quantitative hedge funds, which will have kind of average-ish returns over time, but will never go up, will never go down. And this is what people are managing for, and we're not managing for that. We think like owners. So if a price of a stock that we've invested in goes down in the short run, we don't beat ourselves over it. We actually think of that as an opportunity to buy more. And we actually think it's a great opportunity for our companies too, because a lot of those companies are buying back their own stock. So if they're buying back their own stock at lower prices, it benefits us as shareholders in the long run. So our thought process is very, very different from the regular investment funds that you'll find out there. So we want to look at 5-year track records, right? I mean, at least 5-year compounded returns. On the personal side, I have a track record, over 10 plus years, and that's a very good track record. In the last 5+ years, I've been compounding my own capital at 20% plus.
Wow.
Compounded returns. And that's basically the same strategy that I've taken over here. And that was actually the genesis of the partnership. I was advising a lot of my friends and family with some of the stuff, and it was getting to be kind of unwieldy. And they said, let's pool together our assets in a partnership, and you manage it for us. And that's why I said, my average ticket size is over $1 million that my partners have invested. So mostly my friends and family, and I think the important thing for anyone who comes in and is to think like an owner and to think long term. So if you're thinking long term, you're thinking about 5+ year compounded performance.
Well, and the performance that you mentioned for this year, whether or not you're an actual hedge fund, there's this idea in hedge fund of absolute return, where the main thing we want, our first focus, I think this is from Warren Buffett, is don't lose money. And so
Exactly.
if you're up a little bit this year and the rest of the market is down, well, you've overcome that and done it really well. It's so difficult to overcome those market losses in future years. When you look at it mathematically, you really understand why the absolute return priority is so meaningful. So it sounds like you're doing a great job. And I guess the other thing, you can tell us about assets under management, but just the companies that you're investing in, I'd imagine that your strategy is pretty scalable.
Oh, absolutely. So in terms of scalability, it's the first of all, there's a in the disclosures for the investment partnership, I say that I'm not going to invest in any company below a $500 million market cap, and that's a very, very small number. The smallest investment that we have is like an $8 billion market cap company, $7-8 billion market cap company. Most of the investments that we have are 50+ billion-dollar market cap investments. So the strategy is very scalable. It's not investing in micro caps. It's investing in very, very, uh, the interesting thing is sometimes those companies are not that well known, but they should be. They're Fortune 500 companies. And when I tell my partners about that, they're like, "Oh, how did I not know about this company? Or I've known about this company, but I just have not paid any attention to this company." So these are all well-known companies. These companies are market leaders. The opportunity to expand. So right now, our assets under management are just about, just under $10 million. And coming from a starting point of July 2023, where I started with a very small amount. But the part in terms of scalability, there's no issues, because these companies are very liquid, large market cap companies, a lot of float, and scalability is not going to be an issue until the fund reaches like $1 billion and like multiple $billion or something of that sort.
We hope we're still with you then.
So just to finish off, because we try to keep it around 30 minutes, we like to go with a kind of a personal question, Rohit. And, some people that we ask something about, this question, that there's really great answers. I'm sure you have one too. And that is kind of what keeps you ticking, because let's be honest, investment banking is known to be a very stressful career. I have a lot of investment banker friends who've had health issues actually because of their jobs. And it seems like you're a pretty calm, chill person. So I just would be curious, like, what would you say your personal motto is, or what kind of keeps you ticking on a daily basis?
Oh yeah, that's interesting that you mentioned that, Sarah, because I was not calm like this. Just like the regular investment banking. When I was in investment banking, it was always on the go,
Yeah.
100 hour work weeks,
Yeah.
all the time. And over time, I realized that channeling your efforts in the right places is more important rather than just increasing your efforts, and that has paid more dividend, and that has had higher returns. So so in terms, the interesting thing, you said what makes me tick. I think one of the things that I think about a lot is what Charlie Munger said: is life is all about being rational. And if you're just trying to be rational all the time, and if you're just trying, and it's hard to be rational because there's stimuli all around us all the time, which tend to make us do things that are irrational because we're just trying to follow other stuff and we believe in the wisdom of crowds, etc. But if you just try to be rational, you eventually come out ahead. So I try to do, I try to be rational. I try to read a lot. When I'm not I do a lot of programming, computer programming too, on Fintuative, trying to do financial analysis. I try to read a lot, and I think that's the key to just having the information that compounds. Everything that you're reading right now doesn't help you right now, but it might help you a year, 2 years, 3 years down the line because you have that information. And I think if you're just doing busy work, then you don't have the time to do all this reading and to do all that knowledge building that you can do.
I think you're speaking to two avid readers, so I totally understand. And it's nice to hear you articulate that.
It actually brings me back to a very interesting point. Last year I was at the Berkshire Hathaway shareholders meeting, which was the first one, the only one. I mean, I've watched them all on television and YouTube, but that was the only one I attended in person. It was a great experience. But it was also interesting because I saw a lot of investment managers talk about their investment philosophies and how they're trying to emulate Buffett. And one of the interesting things that I saw over there was that all these investment managers who were talking about Buffett and emulating his strategy, they all had investment teams and they had sector teams and consultants, etc. And interesting that the guy that they're trying to emulate doesn't have any of that stuff, right? He's one man in an office. He goes in, he just reads, and he says, one of the interesting things I read about him was in an interview following the 2008 financial crisis, where they were asking him, the congressional testimony, they were asking about his investment in Moody's, and said, who made the decision? What kind of due diligence did your team do? And how many times did you meet with management? He said, I did not do any. He says, I did all the reading myself. I made the decision myself. There's nobody else who assists me. And I never met with management team. If I thought they needed my input, I wouldn't have invested in them.
Oh, that's
Well,
great.
that's great, Rohit. And I guess all your investors know that the buck stops with you. You're not going to be blaming anybody for anything that goes wrong,
Exactly.
but taking full responsibility. And I like too but I think the thing I like about your story, Rohit, is that you've got this product Fintuative, and I want people to understand that that's separately licensable, right, Rohit?
Correct.
And so you're revealing this proprietary tool that you rely on for your investment strategy to have the success that you described to us, but you're making that available to other people as well. And you're saying, if maybe you don't want to invest with me, but here's a very useful tool that you can use to research these companies, find out about this useful financial data that you're aggregating and presenting. And I really like that a lot, that you've got two things going on here, really, and they're complementary.
Correct.
So I think it might be about time to wrap that up, Rohit. So thank you so much for joining us. And I hope that you'll be a regular guest with us, because you're just, you've got a great way of communicating this vast knowledge that I think you have. So thanks for spending time with us today.
Well, thank you. I enjoyed talking to you guys.
So.
Okay, well, that seems to be a good place to stop, Sarah, and we'll close out here.
Okay.
Any final thoughts? Just making sure that we've given you a chance, Rohit, to share anything else that you wanted to make sure that we articulated.
No, I think that covers everything.
We
Okay.
covered.
Okay.
All right. So thanks for joining us today, everyone, here on Alt Investing Made Easy. Please like and subscribe to our channel.
Okay, and remember, everybody, take aim with your alternative investing strategies.
See you next time.